Welcome, everyone, and thank you for taking the time to join Cobalt Blue for another investor seminar. On today's webinar, you've got me as your host. My name is Joel Crane. I am the Investor Relations Manager for Cobalt Blue. We had scheduled our good friend Will Roberts from Row Motion to join us, but unfortunately something quite urgent's come up for him. He hasn't been able to make it on time. He may be able to join later, but no worries, we'll be able to cover off on the topics that we had already promised to. Also not joining us today is Cobalt Blue's CEO, Joe Katarevic, who is always present on these webinars. But unfortunately, this week he's running around Seoul and Tokyo, so unable to make it. Just a bit of housekeeping. The webinar format will be about 45 minutes in total. I'll start with the summary of our achievements this year, followed by a quick market update, and then we'll discuss what's happening in the LFP market, as it's one of the hottest topics in this sector at the moment. Just so you know, all participants are on mute. If you'd like to submit a question, please do so. Just open up the Q&A box, type in your question, and click send. I'm going to be moderating these questions, and I'll do my best to answer as many as possible, and of course, group the ones together where there's a common theme. But for those that we can't address, we'll try and get back to you offline. All right, let's kick it off. Just in terms of the agenda, we'll go through these 4 topics and leave plenty of time for Q&A. Just heading over to our recent milestones that we've achieved. At the 4th quarter last year, we had a capital raise and a shareholder entitlement, which raised about $22 million Aussie in all up. These funds are going to be used for the rest of the year's activities, namely completing the feasibility study. And speaking of the feasibility study, that is progressing quite nicely. Permitting is well underway, which includes the EIS and the native title discussions. Our engineering, infrastructure, and mining consultants are continually on site, and we continue to guide that this feasibility study will be done by around the end of Q3 this year. Our probably most proud achievement so far this year is what's happening at the demonstration plant. Mining, crushing, and concentration has been completed, and we're putting that concentrate through the kiln to produce a calcine for leaching now. And we're currently in progress running that product through the leaching circuit, and we'll have bulk size samples of MHP as well as cobalt sulfate in the coming weeks. These samples that we're producing now will be used for testing our own product and grade for the feasibility study, as well as sent off for qualification among our several commercial partners. And speaking of those commercial partners, those discussions are still ongoing. Unfortunately, it's very difficult to provide a target date for when these negotiations will wrap up, given that these discussions are reliant on a second party. But I can say with confidence that the interest is large. We're continually traveling around the world, meeting with these parties. And the one thing that we do notice is the IRA continues to have a huge influence on the discussions with major automakers, nickel and cobalt cathode suppliers, and battery producers entering long-term commercial relationships to ensure they have access to IRA compliant material, which of course we qualify for, and therefore that interest for our product remains very, very large. We've seen US automakers establish JVs or buy equity into ASX listed miners and suppliers. And for instance, an ASX miner just announced over the past couple of days a partnership in South Korea to build a lithium hydroxide plant there in South Korea. So these deals just continue to build up, and that's the sort of relationship that we hope to announce in the coming months. So in summary, we do expect to announce that, and it'll significantly de-risk a large part of the funding component of the Broken Hill Cobalt project. And finally, in terms of recent milestones, as many of you are aware, we did receive the Critical Minerals Accelerator Initiative grant in the tune of $15 million. That's been executed as of January. And what that money does is help expand the scope of our feasibility study, such as bringing forward infrastructure services and work packages and decrease startup commissioning risks. And the first tranche of that fund has already been received. So it's just nice to see that real grant money in our bank account. 2 other funding grants we've also received recently. We got $500K through the Critical Minerals Activation Fund through the New South Wales government. And what that does is it helps us enhance our environmental studies. And we also got 20,000 export market development grant to help fund our marketing activities. So it's nice to see we continued support from the government in terms of grant money. And that's part of what you get for being listed as major project status, which of course we received last year. Moving on, there are two very hot topics, obviously, in the global cobalt market, namely what's happening with price and why has it come down so sharply, and also what's happening with the substitution away from nickel cobalt bearing batteries into LFP. So, of course, looking at this chart, you see that all three indicators of cobalt product are at or around two-year lows. If you squint real tightly at the very end of that chart, you can see that the prices over the past week have picked up just a little tiny bit. And of course, we could hope that's a bottom of the market, but probably too early to call that now. But what is behind the sharp drop in the cobalt price? Well, really, it's a classical cyclical downturn driven by strong supply growth at a time of weaker than expected demand growth. Seasoned commodity watchers will recognize patterns in this particular chart and just know that supply and demand fundamentals can have pretty significant swings and thus influence price in both directions. So just digging deeper into both of those fundamentals on the supply side, supply over the 3-year period between 2020 and 2022 grew at a CAGR of 14%. That's global supply. And that's happened while demand was just around 6% growth over that same period. So where is all this supply coming from? Well, it's mainly out of the DRC, which of course continues to dominate cobalt supply availability. And there are 5 large projects, both greenfield and brownfield, that have been ramping up over this period. And during this period, produce an extra 40,000 tons of cobalt, which is roughly a quarter of last year's supply. So it's a big chunky amount coming out of these 5 projects. And that's really a lot for any commodity market to take in. We're talking anything from oil to copper to iron ore, that sort of level of supply growth. It would always have that type of influence on prices. And meanwhile, demand has been weaker than expected. We need to remember that in cobalt's demand profile, you can roughly break it into 3 different categories, roughly a third. First, of course, is EV demand. And we do know that was very strong last year. Sales of EVs up 54% to 10.2 million units. And in 2023, our friends at RoMotion expect another 40% growth to 14.4 million units. So that's just large numbers. But unfortunately, at the moment, that's only about a third of cobalt's demand. Another third of that comes from the consumer electronics sector. And that sector was very weak in 2022. You had China, of course, being the largest consumer electronic market. With the COVID zero policy, demand, not only consumer goods, but all sorts of products across China were experienced negative demand growth. And that was also a global phenomenon, mainly because I think of what we're hearing about the COVID hangover. People stopped buying as many tablets and mobile handsets as we had in 2020 and 2021, as we were all kept at home. I did see one statistic showing that global mobile phone handset sales in 2022 were down 11%. And that's very rare for that segment to be down. So in summary, a weak consumer electronics sector, which soaks up around a third of cobalt's demand, contributed to that demand weakness. And the other third, the final third, is really the industrial demand, primarily among chemicals and alloys, a lot of which goes into the airline sector. And of course, we've seen pretty weak orders as that sector continues to recover from COVID. So when you've got this period of very strong supply and and weaker than expected demand, what you end up is with supply surplus and price pressure. This is not the only time we've seen that in recent history in the cobalt market. Back in 2017 and 2018, when you had supply outweigh demand, you had a pretty sharp drop in the cobalt price. So this is not unprecedented, and it will clear. What is the outlook? Unfortunately, I can't pull out my blue-colored crystal ball at the moment, but it does feel like the price is bottoming. In the trade rags that we read, consumers are reportedly coming back into the market, and the consensus outlook for not only cobalt prices, but commodity pricing broadly in 2023 is quite positive. And that's primarily on the end of COVID zero policy in China. As that market returns, a lot of economic forecasters are expecting some stimulus coming in from China. President Xi, in his speech at the Central Economic Work Committee 2 weeks ago, hinted at some policy stimulus announcements that could be coming next month in the National People's Congress. So do expect some perhaps consumer-driven stimulus out of China next year, and that'll help all commodities, including cobalt. Another couple reasons why commodity pricing is expected to level out this year. We're probably looking at peak U.S. Fed hawkishness and global interest rate rises. And also, because of the higher energy price environment, you've got basically two components there: lifting cost structures across all major commodities, given the amount of energy used to produce, and also limiting refinery capacity, which has a big influence on the battery metals, particularly nickel, lithium, and cobalt, when there's such a very large energy component to that. And energy supply can be quite limiting. So some of the first capacity to get shut down is refining capacity. Next, we'll talk just a little bit here about what's happening on the LFP share rising versus nickel and cobalt bearing batteries. This chart here on the left shows you how large the phenomenon has been in 2018. Global LFP production was less than 20%. And then more recently from 2021, 22, that has risen quite largely. So far, that's been purely a China phenomenon. LFP has only been prominent in China so far. And the main reason is because obviously they have the capacity there, but also because Chinese consumers for electric vehicles have a very different range expectations than customers in other countries. The chart I show on the right here is basically the same type of data, but I wanted to break it out showing even though the share of LFP is rising over the other battery chemistries, so is cobalt demand. That's just a sheer volume issue. EVs, as I stated in statistics earlier, are rising at an extraordinarily high rate, even though the share of cobalt-bearing batteries is less than it was a few years ago. You're still getting a massive explosion in demand over the next 2 decades. And just to break down, I think we do need to sometimes remember, what is LFP, lithium ferrous phosphate batteries, and what's the advantages or disadvantages over the more traditional nickel and cobalt bearing batteries. Of course, the ones that we're exposed to have a higher energy storage capacity, tend to have longer lifespans, have more thermal stability, meaning less fires. The downside to NCM is they, of course, use nickel and cobalt, which are a lot more costly. The primary reason behind the rise in 2020 and 2021 and into 22 of the LFP battery is because of very high and volatile nickel and cobalt prices. So producers in China, which obviously dominates battery producing, we're trying to diversify away from that price volatility. And so far have successfully done so. But what's the advantage of LFPs? Well, they tend to be safer in higher temperatures or sort of more demanding conditions. They, of course, use less costly materials, which is iron phosphate, extraordinarily less cheap than nickel and cobalt. But of course, you're giving up a number of issues, primarily less energy efficient because they're much, much heavier. Apparently, they don't work as well in cold weather. And at the moment, one of the primary problems with LFP is there's very limited capacity outside of China, i.e. they are not IRA compliant at this point. That is my main presentation. Will is trying to dial in, so he can help us answer some of the questions that may arise from this. Hi, Will. Thank you for joining us. But maybe you could jump in and talk a little bit more about the future.
Yeah, absolutely. Thanks very much. So yeah, as Joel's alluded to there, really it's those KPIs between NCM and LFP that are really important and are kind of driving where we see that dynamic at the moment, looking to go up to kind of around 36% next year, but maybe coming back down slightly from that in the longer term, staying kind of firmly in the 30s for LFP. But that really is, due to those KPIs where NCM is going to remain dominant. As we've seen, higher energy density is going to mean longer ranges, and as we look to electrify, towards 100% of the vehicle market, it's going to be really important that those capabilities are going to stay dominant. Is how we're seeing it. So talking a bit more, I guess, then about kind of where LFP is today, how it's working within the market at current, and how that dynamic is kind of playing out. Why we're seeing, some quote unquote dominance in some areas and not so much at all in other areas, and what that's potentially going to mean kind of going forwards as well. So here we're looking kind of on a regional basis and how those chemistry splits are working out at the moment. On the left-hand side, we just have battery demand by region. So as you can see, of course, as you would probably expect, China is dominant, and moving to 2025 is going to kind of hold that position, with a slight change really being Europe losing a little bit of market share in that time as well, as we see more from the US too. But kind of splitting this out by region, in the US, it's still really majorly an NCA story, which comes, of course, from the domination of Tesla in the region, where it's far more dominant than any other region. And this is because they're using NCA in all of their long range vehicles. So in the US, the LFP totaled just under 5% last year, which is almost exclusively Tesla vehicles. They are importing LFP from CATL, so that's that small LFP percentage that we see in the US, but really it's only just higher than 5%, and this is really that consumer preference for Tesla vehicles. So overwhelmingly, we see people going for the longer ranges over the shorter ranges. And of course, if you add on top of that the shorter range vehicles have smaller packs as well, you end up with this really low LFP penetration rate. If you just jump back a couple of slides, actually, Joel, and we can see the same kind of thing in Europe as well. Just over 4% penetration in Europe, where actually the LFP split of Tesla vehicles is higher, but much less dominant as an OEM in the region. And depending on how they operate Giga Berlin factory as well, we might even see that fall slightly in terms of Tesla's LFP in Europe as they ramp up Giga Berlin, although there is possibility that they'll be importing LFP packs from China for that factory as well. But in the long term, I think we are probably expecting more LFP in Europe in the near future, particularly in those smaller entry-level segments. We will touch on that a bit later on as well, though. In China, though, of course, this is really where that LFP dominance is, the largest EV market, and really that weighting on the global share comes from the dominance of the Chinese market. So it's 2.5 times what Europe was last year, 6 times what the US was in terms of vehicle units. And obviously LFP is really dominant there. Also a particularly strong small segment made up a much larger proportion of the total vehicle mix in China than any other region. And it's a segment where last year 85% was LFP. Of course, LFP is used much more across a range of segments in China, but here there's a difference in kind of the electrification of those regions too. So China, longer ranges aren't quite as important. It's more of an urban mobility issue, people looking to get around cities. So you're able to kind of turn to LFP. We see that from kind of the higher density of fast charging units in urban spaces in China as well, reinforcing how that dynamic is working in that market. So just on the next slide then, just a couple of slides to kind of highlight how LFP does fit into that global market mix, and to really hammer home that point that at the moment LFP is certainly being used in those shorter range, smaller applications. So here we're just looking at average pack sizes in the kind of blue for the total vehicle market, or EV market, obviously, and then in the kind of turquoise, just for LFP as well. And we can see consistently that LFP has been smaller over the last 3 years. And it was slightly different actually in 2018 and 19. However, with a much more kind of smaller market, you're almost looking at a smaller sample size. Since 2020, that sample size has really almost been much more worth analyzing in a sense. So both have been growing over the last couple of years. We're up to 38 kilowatt hours for LFP now and 45 kilowatt hours for the kind of total market. And if that does look low, that is across both BEV and PHEVs. But as we kind of alluded to earlier, it does come back to those KPIs and heavy usage in China. So lower energy density, really limiting it to smaller vehicles. And then when we do see it in bigger vehicles like Teslas, like Model Ys, it's in the shorter range versions. So then just to kind of look at this again on the next slide, but from a different perspective, what we've got here is penetration rates. So 2 penetration rates for each region. The dark blue is for vehicle penetration with LFP packs, and the light blue is for battery penetration of a kind of total EV share. In the global region and in China and in the US and Canada, where we see the dark blue being a higher penetration than the light blue, what that means is that the average pack size for LFPs is what we've seen, where it's below average for the region. So where 39% of cars in 2022 had LFP packs as deployed on the road, only 33% of the kilowatt hours that were deployed were LFP. So in this way, you can almost see how, on the face of things, it might look like LFP has a bigger share sometimes than it kind of truly does. Just in terms of, when we're talking about material usage or gigafactories and batteries being manufactured, there is that difference there. So actually looking at Europe and the rest of the regions, it is the other way around. So Europe, the LFP average pack size is actually slightly above the standard average pack size for the region. But as we can see there, Model 3 and Model Y sales just completely dominate in both of these regions for LFP vehicles. Not only kind of showing that the variation in models available for LFP is really, really small, but just how much weighting kind of one model can have on things at the moment at this kind of early stage within electrification. So 94% of sales in Europe that had LFP were Model 3 and Model Y, and 73% for the rest of the world. So we actually did this for kind of every vehicle segment as well, with average pack sizes comparing LFP to the standard. And we only found in 2 vehicle segments, so that's your A, B, C, D, those kind of vehicle segments, was LFP above average. And one was the segment, of course, where the Model 3 sits, and the other one was a kind of, more obscure, underrepresented segment at this point in electrification as well. So again, kind of across the board where LFP does come into larger vehicles too, and in smaller vehicles, we still see it being smaller than average. So kind of looking forward as to LFP outside of China, as we've alluded to, LFP is well established within China, and we of course expect it to stay that way due to the market dynamics there. But the big question is often what's likely to happen with LFP in Europe, excuse me, and North America as well. So starting with North America, obviously really big news recently with this new Ford and CATL deal. So just run over the details: 35 gigawatt hour plant in Michigan to produce LFP batteries, coming online in 2026. Also, LFP option going to be available in the Mach-E this year and in the F-150 Lightning next year. I think it's important to say as well with this deal, there is some still kind of, I guess, political wrangling to come with it. Having spoken to people in North America and people, who've got a keen interest in the value chain and keeping an eye on this deal, they're still trying to establish, how is this going to work out politically? Up to now in 2023 for the IRA, we've also seen, some members of the US government express kind of disquiet on the implementation of the bill as it has been, and maybe where that might be misaligned with the intentions of the bill starting out, they may be looking to kind of make sure that the bill is being implemented within the spirit of it as they see it. You could see that this deal, Ford and CATL, might be at consonance with what some see as the spirit of the bill, and therefore there may be some more political wrangling to come in terms of how this is allowed to happen. I think it's also important to notice that it has been reported as well that the Chinese government might be looking at this from the CATL side to make sure that they're not sharing technology with Ford, although I don't think that's expected to put too much of a stop to it at the moment. But again, so when we then look at the deal, let's say it all goes through, let's say it's IRA compliant, what does it mean? What does it mean really for America and for Ford? Again, we can remember that these is just going to be an option for customers. And looking at what we've seen from Tesla's LFP experiments in the US, still only a really small percentage of batteries deployed. And it's going to be the same thing for Ford. These are going to be kind of short-range Mackeys, short-range F-150 Lightnings. They've already talked about how with the F-150 Lightning, a big part of their customer base is going to be commercial buyers, fleet buyers, kind of people that use their F-150 Lightning only in local areas as maybe like a tradesman or something like that. Therefore, maybe they don't need a massive range. You can use higher kind of cycle life of LFP as an advantage there, maybe, but not have it as kind of your volume version of the vehicle. Ford already has multiple commitments to NCM based factories in North America. Kind of 3 with SK at the moment. So this is in no way a kind of whole strategy switch. I think it's more likely that this is really about volume of vehicles on the road right now for Ford. So we've seen their production capacity look to grow multiple times since kind of Mach-E was released. So both for the Mach-E and the F-150 Lightning, they've been upping those vehicle volumes. And getting LFP from CATL in the near term is going to be a way it can grow that EV production as fast as possible. So providing for the subset of customers where that short range is going to be okay. Obviously covered Tesla a lot already, but just to touch on it in North America as well as potentially being the other source of LFP there right now. Again, so only 8% of North American sales LFP at the moment. That's where we then reach down to about 4%, with Tesla having roughly kind of 50% of the market in the US. We have seen recent announcements for a huge expansion of the Nevada battery site up to 100 gigawatt hours. However, these cells aren't expected to primarily be LFP. They're going to be needed primarily for expanded car production, with Giga Texas coming online, and potentially more factories in the future in North America, maybe Mexico, maybe Canada, something like that. Then these cells are going to be primarily needed for any maybe new vehicles, or the Cybertruck, the Tesla Semi as well. Strong rumors of a new semi plant coming online in Mexico shortly. That's going to eat up a lot of cells if they're going to go hitting those targets that they have set for Tesla semis. I think they've said 50,000 Tesla semis in just a few years' time. That's a lot of cells needed there. Where the LFP maybe comes into that on the Tesla side is that they have mentioned that this could be used for stationary storage, for which Tesla does have a strong strategy for LFP. In the last couple of years, they've basically moved their whole Megapack side of the business over to LFP, currently getting those from CATL as well, probably, don't quote me on the volumes there, actually. I was going to say probably more than what they're putting in cars, but not 100% sure on that. So yeah, not necessarily going to see Tesla made LFP in vehicles anytime soon. It is something that they could always pivot to potentially in the future, but right now, not necessarily what we're expecting. So kind of taking all of those things into account, we're maybe looking at peak penetration in the US of around 12 to 15%. This is not exactly kind of what we have in our forecast at the moment, as it's almost a bit of a scenario-based situation where as people are going to make more commitments and move towards those chemistries, then what we forecast is going to start to reflect that. This is really if people make more commitments up to a level beyond where they are today, then these are the kind of penetrations that we think they could get to in those regions. So in Europe,
Will, if you don't mind, I'm just going to interrupt you for a moment.
Sure.
So to get a question, I made quite a bold statement in my previous preamble saying that LFP is not IRA compliant. It's a bit cheeky, just because at the moment all of the LFP capacity is outside of the US and in China, therefore not LFP compliant. So two questions. I assume that it can become IRA compliant if it's being produced in Nevada or Texas. And then also maybe just to start with, will the Michigan Ford plant with the CATL technology be IRA compliant?
Yeah, so it's something that I've been getting a lot of questions on as well, even from people that, maybe I would have expected to have a better idea than me in the US, which I think just off the bat shows that maybe the answer isn't quite known just yet. Ford obviously think it will be, but also the term IRA compliant, could be quite broad here. So let's kind of break it down into the different bits of the IRA, which it may be compliant for, and the bits where it may not. So there's two sides to this. One is the clean vehicle credit, and that's the $7,500 that the consumer is going to be eligible for the car if the battery materials are IRA compliant. So that's one bit, and we'll come back to that because it's potentially a little bit more complicated. And the other bit is the production tax credit. So the production tax credit, we're looking at $35 per kilowatt hour for producing cells, and then $10 per kilowatt hour for producing modules. So effectively $45 per kilowatt hour for producing cells in North America. And that doesn't have the same material sourcing requirements as the clean vehicle $7,500 credit. So what we do expect Ford are most confident about in terms of compliance is this production tax credit, because on the face of the deal, they own the site, they own the manufacturing. They're essentially licensing CATL for their knowledge of LFP at the moment, and therefore, regardless of where that kind of material is coming from, probably expect them to be eligible for $45 per kilowatt hour of production. Given the cost of LFP being slightly lower anyway, that could be a serious advantage and almost enough of an incentive for Ford to kind of go ahead with this anyway. The one that's had more focus is the $7,500 vehicle credit, where I think you're probably absolutely right, Joel, that I don't expect that to be IRA compliant as it stands. So that's where we're looking for material to either be sourced from the US or free trade agreement countries. All of that knowledge and that supply chain, as you say, is basically in China at the moment. The NCM supply chain is much more diversified, while a lot of it is obviously in China too. With LFP, it's basically all in China. So it's very difficult to see how they'll have a supply chain set up where they're using CATL and not have that LFP supply chain coming from China. Add on top of that, the potential for this entity of concern restriction with the IRA, which is where coming in a year later, so next year, if any of the material is coming from China, then so extracted or processed in China, then the battery won't be eligible for that $7,500 credit, regardless of whether that's the half that's being material sourced or the half that's being manufactured in the US, if any of that material is coming from China. So in that respect, don't expect the $7,500 credit to necessarily be applied to those Ford LFP vehicles where they're working with CATL.
That makes a lot of sense. I might just summarize then this LFP issue and what it means for us. And the key question is, are we worried as a future cobalt producer about the rise of LFP market share? I think what you've heard here sort of demonstrably answer the question that no, we're not particularly worried. I've already showed you the chart of even on our current demand forecast of LFP share rising. Cobalt demand is rising significantly. We're going to need twice as amount of cobalt as we're using today by early 2030s, even with those LFPs coming to market. As you pointed out, Will, there are multiple deals around the world. We're talking decade-long, multi-billion-dollar deals, particularly in North America and Europe, with NCM, nickel cobalt-based battery technology that just shows you that the auto producers are very locked into this particular technology. We did talk a little bit about storage and the fact that energy storage systems generally use LFP, but energy storage systems have a very small percentage of overall battery demand, sort of anywhere between 4 and 8% over the next 10 to 20 years. So yes, those are pretty much all LFPs, but a very small segment of demand. So in summary, it does not worry us. And it's not, in my view, it really is only a natural evolution of the market that you'd see um, in EV producers wanting to diversify their product range. We might just move on to some more question and answers. Will, I've got several people asking, what is the recyclability of LFP? Given the future requirements, particularly in Europe, that car batteries must be recycled, is there technology and is LFP easily recycled?
So it's not my exact area of focus, I would say, but I do have some kind of overview of what I think is going on there. My understanding is that it's not that you can't recycle LFP. I think the technology does exist and is in place, but in terms of the economics, basically, of recycling LFP, it's a much harder use case. It's a much harder kind of case to make. I think that's maybe something that's been particularly pertinent in Europe, as you mentioned, over the last couple of years. It was really 2021 where the start of these kind of noises from European OEMs on the LFP side started to come through. So like we see on the slide that VW and Mercedes both kind of made some noises towards LFP, and then it's all gone a bit quiet since then. And really what's happened in the meantime is they've realized that in 10 years time, the vehicles that maybe they would be looking to be putting LFP in, they need to be recycling those batteries as well. And they need to be making sure that that circular economy is going to work for them. So I think that has maybe held them back a little bit in the last couple of years in terms of going for LFP, because it is difficult to justify getting to that full circular recyclability at the end of life as well.
Thanks. I spoke with a analyst at CRISO, the Australian government-sponsored research arm who specializes in this, and he said it is much more difficult, primarily simply because of the economics, that the materials you're talking about recycling are so much less expensive than nickel and cobalt. So that's part of the reason. So if they're not easily recyclable or not economic, it'll be difficult to take significant market share in Europe. Okay, moving on to probably the most popular question we're getting today. There was a news report over the past day or two about the issues happening at the 10K copper cobalt mine in the DRC. This mine is owned by CMOC, or also known as China Moly, a big diversified Chinese mining company. It's one of the largest copper cobalt mines in the world. They've had a dispute with the government since the middle of last year, and the government revoked their export license. So now this particular report is claiming that there's around 10 to 12,000 tons of cobalt stockpiled there, which is really around 5% of annual supply. So it's a big chunk. And the question is, well, what is our view that's going to happen to that market? Look, this is not the first time a particular commodity has been stockpiled somewhere for either some sort of sovereign risk issue or a price control issue. But in my view, the material is unlikely to flood the market. And this is for a couple of reasons. Number one, logistically, getting material out of the DRC, which goes south through South Africa to these roads are notoriously difficult to get through, and there's already massive queues. So it's not like you can just push this material out all at once. And if you think about it from the owner's point of view, CMOC being one of the largest cobalt copper producers in the world, why would they want to flood the market and pressure prices even lower? So I think they'll take the opportunity with this stockpile, to manage it and perhaps even manage price to the upside, which means continue to withhold it from the market, and maybe they could get some better spot pricing in the future. So that's the view on that. Look, these things are always evolving and often unsubstantiated, so it's difficult to really get to the bottom of it. A couple more questions, specifically on Cobalt Blue. Sorry, we'll come back to you in a moment.
No problem.
Is the demonstration plant running at 24/7 as previously guided? Yes, we have done several 24/7 campaigns just to test for our feasibility study, what that looks like and what are the economics around that, and make sure the staff is well trained. So that's happening both on the mine site and in the demonstration plant where we're producing MHP. And like I said at the beginning, that MHP is being produced now, and we'll have larger bulk samples in the coming weeks. So into March, I assume we'll be able to announce that we've got relatively chunky amounts of MHP, which is all quite exciting. Let's see, more questions that are Cobalt Blue specific. A lot of questions on the share price. Look, obviously something that is difficult or impossible for us to control. I know that some of you online, I've spoken with you individually. We've talked about the strong correlation between the Cobalt price and the Cobalt Blue price. Obviously, we have that's an exogenous effect. We have no control of the Cobalt price, nor will we ever be able to. So we're just sort of having to stand by and watch that occur. Look, I've been in commodity markets for almost 2 decades and watched supply and demand cycles come through in and out, and you'll see both highs and lows. As that chart I showed you before, and I know there's a lot of chartists out there, we are at a 2-year low, and really some of the lowest cobalt pricing has ever been. While the supply continues to come out of DRC and these 5 projects that I mentioned that are ramping up, that'll slow down at the end of this year and going into next year, and the demand growth will catch up. When the market and the price setters will anticipate that, it's hard to know. Often in commodity markets, particularly when you have visibility in markets like cobalt, which given the relatively small size, it's easier to see. Commodity market players tend to front run that impending supply gap by 6 to 12 months, meaning you could see a significant price recovery maybe in the second half of this year into next year, and that's what we'd expect. So for those of our shareholders, I appreciate you still hanging on and understand it can be a tough ride, but that's the sort of world we live in. We are exposed to a cyclical commodity like cobalt is. We've sort of touched on the IRA a bit, Will. I might just ask a few more or try and address a few more questions for those of you willing to stay on for a bit longer. Will, we touched on the IRA a few times, but there is apparently some new or refreshed guidance coming from the U.S. Department of Commerce. Can you enlighten us on that?
Yeah, so obviously with the original bill, the timeline that was set was the end of 2023, which from, sorry, the end of 2022, which from August, I think we always thought was probably quite ambitious, which did kind of turn out to be the case. So our US government guidance was that they were delaying the full guidance for those battery component and battery critical mineral conditions until March, which means that at the moment we're kind of sitting in this limbo period where the toughest parts of the regulation, which are those battery component and battery critical mineral parts of the legislation, aren't in force. So essentially, to qualify for the full credit at the moment, you need to make your vehicle in North America, and you need to meet the MSRP guidelines, which are 55,000 for cars and 80,000 for SUVs. There was some back and forth on that at the start of the year with some strange definitions for SUV, but that has been kind of resolved now. So yeah, that means we're expecting more full guidance in March. They did give a white paper at the end of last year into what they expect that guidance to maybe look like, which has still left a lot of questions on the table. So things like that kind of Chinese ownership. There's a 51% owned lithium project in South America in a free trade agreement comply with the IRA or not. It's just not clear. That the answer isn't known at this point. And hopefully, these are the kind of things that they're going to have to lay out in March in much more detail. Things like free trade agreement countries. We've got a list of countries that are definitely on the list. Australia is definitely on the list, but there's also room for that to be opened up even further. Korea are hopeful for more of a close relationship there. Hyundai Kia aren't necessarily happy that their cars are excluded at the moment for not being made in North America, even though they do have plans to move that way. And Europe, of course, is unhappy that it's not necessarily included in much of this as well, as the EU and US don't have a free trade agreement. So yeah, a lot more to come in March, and a lot more questions, I'm sure, to come off the back of that as well.
Thanks. I got a number of questions on what's happening with a segment of the market that we've been talking about for a long time, which is sort of a ethical or green premium to commodity markets. And just circling back on this IRA compliance, I think this is all part of it. So it may not eventually be called a green or an ethical premium, but there certainly is going to be a mad scramble for tons, not only of cobalt, but as Will pointed out, lithium and nickel that do tick the boxes on legislation such as the IRA and the eventual legislation that will come out of Europe as well. So while there may not be something called an ethical premium, I think that IRA compliant producers such as us and a number of our peers will be able to ask for a premium on top of that. And that's something hopefully we'll be able to give more detail as we enter the market. But that's how I think this green/ethical premium market is going to develop, really more due to legislation than anything else.
Yeah, and I think one other thing on that in Europe is maybe the prevalence of battery passports. It's not necessarily clear exactly how they're going to work at the moment, but there's a couple of proof of concept projects out there showing the kind of full traceability of the battery back up the supply chain, as well as carbon intensity of those batteries as well, which if becomes the standard for the industry, that is essentially legislating a green premium on some materials.
Cool, thank you. All right, I'll just do one final question, and it's one that's company specific. Sorry, Will, but a lot of questions on updates for our waste streams project. This is, of course, our ability to use our technology to treat tailings dams or other waste dumps, not only in Queensland, but across Australia and perhaps even across the world, as these are increasingly identified. We don't have any major update beyond what we've already guided in the few samples we've already treated. But the fantastic thing about the success of our demonstration plant, as I've discussed, that is fully operational now, is once we're done treating our own product, our own concentrate and our own material that we pulled from the mine earlier in the year, we'll be able to then use that demonstration plant as a research facility to look at different sources of waste. So look, we have a lot of live conversations with the owners of these waste products, and they're ongoing. But given our focus on the demonstration plant and the DFS, it's sort of in the sidelines. But like I said, lots of live conversations. And once the demonstration plant ramps down about mid-year, it'll be full-time being used as a research center. So there'll be plenty of news coming out of this space, and we're very excited about a number of opportunities that have come across. Look, that's it. I'll wrap it up from there. Will, thank you very much for joining us. Your insights and expertise is always appreciated. And to you, the listeners, and especially our long-term shareholders, we appreciate you hanging on. You can always reach out to me. I'm sorry if I wasn't able to answer your question today. I'm happy to take that offline. And stay tuned for more and similar updates. And with that, I will conclude the webinar. Thanks, everyone.